Heightened tensions in the Strait of Hormuz are continuing to disrupt global oil flows, and refiners are right at the center of that volatility. From rising costs to shifting margins, the pressure is building across the sector. I'm joined by StoneX Director of Energy Market Strategy, Alex Hodes, to discuss what this means for refiners globally. Thank you for joining us, Alex.
Thank you for having me.
So how would you characterize the current situation in the Strait of Hormuz? What are the latest updates and what it means specifically for global refiners?
So the strait remains impeded and essentially closed with regards to ships are not really traveling through there right now. A lot of it is due to lack of insurance providers. There's been kind of reports of mines in the strait as well as attacks on ships. So again, we're kind of just halted in regards to the flows of oil through the Strait of Hormuz. As far as kind of the latest updates, that's a minute to minute thing. So you get one side talking about any potential uh, progress towards peace. And then the next headline you see is that there's no progress towards peace. So, kind of trying to digest the headlines is a fool's errand right now. But as you look at kind of the ship flow, there's nothing really of substantial volume flowing through the strait.
And what are the immediate operational challenges refiners are facing right now?
So there's a few different, depending on where the refiners are, they're kind of affected in different ways. So in the Middle East specifically, there's been actual attacks on refiners. And then when you see in Asia, those refiners are typically more exposed to the Middle East crude oil grades. So they are the most exposed with regards to supply, and they are several of these refiners have reduced run rates substantially, and thus you're seeing a lot higher refinery margins globally. But there are kind of some differentiations depending on where you're at in the globe.
I was going to say, are we seeing a clear split between winners and losers among refiners globally?
Yes, and that's really with regards to the grades of crude that the refiners are typically used to importing. So some refiners are kind of scrambling for alternative grades of crude. So these grades of crude in the Middle East, there's alternative suppliers, and it's not always perfect, but those suppliers are kind of some of the more LATAM focused suppliers, Colombia, some crude coming out of Brazil as well. So really the winners and losers, where you're seeing the biggest benefits, one is the U.S. Gulf Coast refiners. So because of their ability to export grades of or export refined products, as well as their exposure to their lack of exposure rather to the Middle Eastern grades of crude, they have some availability of Canadian crude to fill in. And so they are really the big winners here. And then you're seeing some of the North African refiners, those that are not have to export flows in the of taking advantage of European refined product buyers as well. So you're seeing a little bit of benefit there. Some of those countries tend to be still import dependent, so it's not a clear cut winner in that case. But you are seeing just overall refiners that are able to operate and export are the ones that are benefiting right now. The Asian refiners are definitely taking it, having a little bit more of a negative impact than the rest of the refiners globally.
And let's talk about margins. What's happening to refining margins in this environment?
So globally, they are extremely elevated. If you look at just a when you look at refining margins, one way to look at it is just to look at the future product. So you're seeing crude oil with respect to uh, gasoline and diesel prices. You're seeing gasoline and diesel prices substantially high. However, when it really comes down to the actual physical market, there's a little bit more of a difference here because the physical market is actually, you're seeing sometimes crude oil physical prices are even more elevated than WTI and futures products. And then the local markets are not as elevated physically as they are on the futures paper market. So it kind of depends, but overall, they are elevated from historical levels. And that's going to be, we think, is going to be persistent even if the strait does open up, because there's been such damage to the refining capacity in the Middle East. And if you're seeing any Asian refiners that are kind of turning down refining rates, they're going to be playing catch up there. But right now, we're in this environment where anybody who's able to refine and take advantage of exports, specifically the Gulf Coast refiners, they're running at elevated rates. And this is an environment where when you're running extremely hot, that does tend to lead to kind of more issues. So any refineries that go off due to unplanned maintenance, we've seen Port Arthur refinery in the U.S. Gulf Coast experience a fire. So these things tend to happen a little bit more frequently when they're running at these elevated rates, when everything's kind of pushed to the brink. You're seeing export terminals pushed to the brink as well. So just in that environment, it leaves it a lot more prone to some of those issues as well.
And to what extent are demand dynamics starting to matter for refiners?
So this is another one of those kind of regional differences you're seeing globally. So right now, and to be honest, kind of on a product basis as well. So Asian markets are going to be the ones that are, you're seeing some of that Asian demand getting hit. So diesel demand destruction is definitely getting hit. Um, Jet fuel demand was one of the first areas of concern. So you've seen a lot of airlines cut some routes or kind of redirect their routes, and certain ones in Asia specifically, you initially saw reports of jet fuel unavailability, but these airlines are able to kind of just manipulate those routes and price it accordingly as well. So you're seeing some demand destruction there on that front. And then some of those countries are instituting kind of work from home, use of public transit. But then when you look kind of towards the US, we haven't really seen any of that quite yet. Gasoline numbers are coming in, gasoline demand numbers are still above average. And if you look at the overall total product supplied in the US, when looking at the most recent EIA data, which was just released yesterday, the demand overall in the US is coming in 1 million barrels per day above the 5-year seasonal average. So we haven't really seen a demand destruction coming to the US quite yet. But that's kind of normally due to the price increases. And once you start seeing exports continue and you start seeing US barrels try to price those barrels out of going abroad and staying at home, that's when you're going to start to see some more of that demand destruction. And one of those that's going to be kind of more of a political concern will be the gasoline prices. So that's something we're going to keep an eye on for sure, but we have not seen really demand destruction yet.
Well, thank you very much for your insights, Alex.
Thank you.
For more videos like this, please do like and subscribe.